Welcome to Friday Takeaway. This week I look at two leisure-related stocks, AirAsia and Genting Malaysia. But we start with US President Donald Trump is in the news again, and again for the wrong reasons. Michael Cohen, his longtime lawyer and fixer, turned on Trump this week before a congressional committee, calling the US president a racist, a cheat, and a con man who sought business deals in Russia during the 2016 elections, and inflated his net worth to impress the public. Cohen said, Trump is capable of behaving kindly, but he is not kind. Trump is capable of committing acts of generosity, but he is not generous. And that he is capable of being loyal, but he is fundamentally disloyal. In response, Republicans attacked Cohen as a pathological liar. And so the saga continues. Pakistan and India relations deteriorated, with both facing the worst conflict in almost half a century, after an Indian military jet was shot down over disputed Kashmir territory, and an Indian fighter pilot was captured by Pakistani forces. Tensions between the two nuclear-armed neighbours have escalated sharply since India carried out a preemptive strike on a terrorist training camp in Pakistan, saying it had killed a large number of prospective jihadis. Relations between India and Pakistan have plummeted since a suicide bombing last month that killed 40 paramilitary police in India's Kashmir region. Back home, the newspapers are reporting that the aviation regulator, MAVCOM, may be disbanded. That's a proposal that is currently being evaluated by the Transport Ministry, part of the government's role and move to control costs while regaining control over key decisions in the aviation industry. Now, this all came hot on the news that tourist arrivals failed to meet targets for the 8th straight year. Some 25.8 million tourists arrived in Malaysia in 2018, lower than the target of 26.4 million, as well as that of our neighbour Thailand, which welcomed 38 million arrivals last year. But there were some bright sparks, including per capita expenditure and average length of stay, which both increased year on year, with data showing that tourists now stay 6.5 days on average each visit. In this week's This or That, I look at two leisure industry stocks, AirAsia and Genting Malaysia. One offers budget air travel, the other is a casino, hotel and resort operator. Both are billion ringgit bursa stalwarts and loved by investors, but experts say AirAsia's prospects seem bleak due to stubbornly high costs, while Genting Malaysia seems to be in recovery mode after a disastrous 2018. Let's find out more. Genting Malaysia is a casino, hotel and leisure conglomerate with operations in Malaysia, the UK, Egypt, US and the Bahamas. But its main revenue comes from right here in Genting Highlands, where its 10,500 rooms over 7 hotels feeds the country's only casino. Full year 2018 results beat forecasts due to lower tax rates, but operationally it was also a good year as local gamblers punted more, as did the high rollers. Analysts say Genting Malaysia's final quarter earnings beat street estimates by around 17%, helped of course by the lower taxes. And investors were also buoyed by final quarter dividends that were higher than street estimates and that were also higher than last year's print. Analysts say the tax hike in January is the key focus, after facing a severe sell-down last year following the 10% hike in casino duties, termination of 20th Century Fox theme park, and a huge 1.83 billion ringgit impairment for the US tribe's promissory notes. But Genting Malaysia has bounced back with a 15% year-to-date gain. Now, with sentiment improving, focus now is on the casino duties hike, which took effect in January. Thus, the next quarterly results in May should offer more clarity about how the 10% additional tax could impact its bottom line. On the other hand though, there's still no update on the outdoor theme park, as the legal case is still ongoing. Of the 21 analysts who cover Genting Malaysia, according to Bursa Marketplace, 7 are either a strong buy or a buy, 10 are a hold, and 4 are either a reduce or a sell. With a consensus target price of 3 ringgit 57 cents, there is a potential 2.4% gain to be had if you buy at around what the current levels are. First listed in 2004, AirAsia pioneered the short-haul low-cost carrier model in ASEAN. They've since then grown into the region's top low-cost airline, with over 130 destinations across the region. Together with their affiliates in Thailand, Indonesia, the Philippines, India and Japan, AirAsia is the largest LCC in Asia by passengers carried. Analysts say AirAsia's results were a big miss last year due to a raft of negative factors that included a 33% rise in average fuel costs, a 49% increase in maintenance costs, a 55% hike in user fees, 101 million ringgit in professional fees, 60 million in doubtful debts, and an 84 million ringgit spike in staff costs. With all of the above, plus a 6% drop in ticket prices, operating cash flow plunged 60% on the year in 2018 to 970 million ringgit. More worryingly though, costs are expected to stay high and continue to be AirAsia's biggest hurdle this year. Management have indicated more hedging against volatile jet fuel prices this year, and on the non-fuel front, a few cost-cutting initiatives have been lined up, including a 10% headcount cut and closing their call centres with humans to be replaced by automation. But again, with higher costs being incurred by the group's non-aviation segments like Big Pay, cost savings are expected to be marginal at best. Of the 21 analysts who cover AirAsia according to Bursa Marketplace, 13 remain either a buy or a strong buy, while 5 are a hold and 3 say reduce. Now with a consensus target price of 3 ringgit 28 cents, there is a potential 18.4% gain if you buy at around what the current levels are.